What is going on, traders? Welcome back to the Traveling Trader. Let us get right into it. Looking at the markets, we see that the S&P is down 1.5%. Same thing as Dow Jones. NASDAQ down about 1.25%. If you saw my last video, I was talking about why the S&P would decline and potentially test the 50-day moving average. We are already at the 50-day moving average. We have now retraced back up a bit, but it has been tested or close to it. In anticipation, we bought SPXS, which is the inverse of the SPY. So essentially shorting the S&P 500. And I sent out that alert yesterday in the trade alerts, as you see here. Yesterday, just right after market close, I sent out that I was buying the SPY in anticipation of this move right here. And if you want access to the trading group and the trade alerts, all of my ideas, the moves that I'm personally making, link is in the description. So let us go over the topics for today. As I said, the S&P 500, why it's dropping. I'll go over that a bit, review what I said in my last video from a couple days ago, and then what needs to happen for another major rally. There are a few economic indicators that would signify another rally, or a real rally, I should say, because this right here, this is just called a melt up, or there are many words that you can use to describe this, but a bear rally, a melt up. Some might even call this a dead cat bounce, but I mean, this rally has been, going on for almost 2 months, so a little too long to call it a dead cat bounce in my view. But either way, the general consensus is that this rally is going against what the economy is doing, and obviously the stock market is not a true reflection of the economy, but it isn't even a reflection of what the businesses are going through right now. Aside from big tech, obviously big tech earnings pretty much unaffected, but aside from them, every industry is battered right now. So this isn't a reflection of negative earnings in almost every industry except for tech. Let's go back to the checklist. So what should you do here? Obviously, besides the speculative strategies, as I said, we bought the inverse to the S&P yesterday, and I'll go over the rest of the shorts and the option plays. We had some pretty sweet ones here, but we don't need to reinvent the wheel. Just as I did on the week of the first stimulus, March 23rd, stuck to buying the blue chips. And obviously we're talking about most of these now will be big tech stocks, but certainly there were some strong retailers like Nike, Home Depot, as well as a couple of fast food places like McDonald's. There isn't really a need to reinvent the wheel when the markets crash. Same thing happened in 2008. Buying up blue chips was your best bet. Even something like Bitcoin, when Bitcoin does crash to anomalous levels, your best bet is to buy the dip on the blue chips, which in the crypto world, Bitcoin is definitely the blue chip. What else should you be doing? Well, in my view, you should stop buying distressed markets. There definitely is a case, and obviously we've entered airlines incrementally, as well as beating up bank stocks, right? I mean, you could enter these things slowly, but you shouldn't blow your whole fortune or your whole budget on these distressed markets, at one price point. If you look at the S&P, and I'll take a look at the even more detailed economic indicators here, like the bank index as well as the S&P industrial sector, but there's still a lot more bloodshed to be had. So yes, it's smart to not try and find the bottom. It's smart to scale into distressed markets as well. The bulk of your portfolio, in my view, should be blue chip stocks, but it's smart to scale into distressed markets for the long term. Obviously, airlines will resume at some point. Hotels will resume at some point. So as a very long-term bet, it's an okay move, but we shouldn't keep dumping money into them. You should let the markets continue capitulating before putting in more money into these distressed markets. Like I said, your best bet, in my view, is to stick to the blue chip stocks for the bulk of your portfolio. And then I'll go over the shorts and option plays. Like I said, some really sweet plays here, taking advantage of what, in my view, was a clear direction in the markets. And lastly, I'll go over Bitcoin. So let us get right into it. Looking at the SPY, again, I'll just go over a high level of what I said in my last video, but we have the death cross here between the 100 and the 200 MA. We had the hidden bearish divergence between the price, the RSI, and the MACD. We had this double top pattern here that I pointed out yesterday in my analysis in the trading community, and the S&P does not do well with double tops. You'll see every time we have double tops or triple tops like we had here back in 2018, or even here in early 2018, we had a double top that signaled a drop to test the 200 moving average. Really, you can keep going back on the history of the SPY, and every time you see this double top pattern, you see a major decline thereafter. So that was one of the major signals as well, forming this double top. Not only a double top, but a double top at the resistance of what is currently the retracement from the pandemic crash. We tested the 50 moving average, and in my view, we'll test this probably a couple more times, and there is a chance we can break to the downside. And in the midterm, we probably will. This is the area that I'm eyeing in the midterm. And as you see here, this is an area of a lot of action going back, from March to April. You see a lot of action happening here, a lot of support and resistance, a lot of candles being played here. This is a very plausible level in the midterm. Whether we get there next week or in 4 weeks, we're not fortune tellers. That's not the point of technical analysis, but this level is identified in my view. All right, so what needs to happen for another major rally? In my view, what needs to happen is, if you look at, and this isn't an original idea, this is a notion that has existed in markets for a long time, especially during crashes, but there are a couple of sectors to hone in on. The KBW Bank Index, this is just the NASDAQ Bank Index, which is represented here by the candles, as well as the S&P Industrial Index, which is the blue line here. As you can see, that they follow each other very closely. But usually these things tend to outpace stocks in a recovery. So these things tend to rally before the larger indexes like the S&P 500, or they tend to rally with the S&P 500. But you could see that there is a divergence here, because after March 23rd, like I said, this was the week that the first stimulus was passed. We just rocket shipped all the way up to, we can even measure this move in terms of percentage, but we went really from the bottom here when we saw around 218 on the SPY to the top. That's a 35% gain within the span of less than 2 months. But if you look at the bank sectors and the industrial sectors, yeah, we saw a gradual rally, hit the 50-day moving average on both, but then started tanking, and now it is pretty much divergent from the S&P 500. So these two sectors need to see a real rally before we see an official rally in the stock market. And this right here, by the way, is called a melt up. And if you've never heard that term, I'll link to an article down below on Investopedia. But a melt up is actually an official term. It's just not used a lot because, well, one, we don't crash this hard quite often. These crashes come on average once every 10 years. But even during the Great Depression, right, or the Great Recession, you see that as unemployment rates continue to be high, somehow the markets continue to rise. But this is all just based on momentum here, and momentum from those who have money, as well as obviously the Fed coming in and saving the day, pumping up the markets with printed money. And we've never seen levels like this before, but basically it's a sudden rise in price due to an investment by a stampede of investors interested in profiting from the gains in price. And obviously I'm guilty of this as well, right? I bought a bunch of stocks right here the week of the first stimulus, but I didn't think that was the bottom. I thought that was a good marker to lay my first foundation of asset buying during the crash. Anyway, whether we'll match these, March 23rd bottoms or not, I don't know. I personally don't think so, at least not in the midterm, only because that would also mean that a lot of the big tech stocks, which have had record earnings during this pandemic, would also need to crash to that level. All right, let's go back over the checklist. What needs to happen? I talked about this already, but buying blue chip stocks during the crash, that's what I did. If you take a look at my portfolio, you'll see here, and I've been over this already, but Tesla, Visa, Amazon, Microsoft, Google, Home Depot, Disney, Nike, Apple. These are mostly stocks that are household names. And like I said, I did scale into airlines and banks as well. Those right now are just taking a beating, but luckily I'm being saved by the rest of my blue chip portfolio. And I will not continue buying banks and airlines. I feel like my portfolio is already maximized for those sectors. I don't want to dedicate more, I don't want to dedicate a higher portion of my portfolio to those sectors any longer. If they do keep getting battered and they are just at obscene levels, then I might consider adding more. But at this point, I'm good. I don't need to add more. You don't want your portfolio to be lopsided to where it's taking taking a beating every time these sectors take a beating as well. All right. Like I said, stop buying distressed markets. This is only my view. It's your money. You can do what you want. But if you already have a certain portion of your holdings in airlines, hotels, etc., I would not buy more at this point. Shorts and option plays. This is really the fun stuff for me, only because, you know, it's I'm a speculative guy. I like speculating on the market, especially when the directions are somewhat clear. So like I said, SPXS, as we see the S&P falling here. I also shorted AMC being the movie theater company. I shorted AMC because it was up. It was disproportionately up, you know, because of some hysterical trading due to a rumor that Amazon was going to buy AMC. And if you take a look at AMC, I'll show you what I'm talking about. But AMC stock jumped, I think it was like, yeah, 30%. It was on this day, May 11th. So it jumped 30%. And taking a look at AMC, you can see that every time on the 1-day chart, it really doesn't hold very well above the moving averages. Even when it does pop above the moving averages, it tends to crash. And so because this rumor was unfounded, the story now is that Amazon was eyeing AMC, the network, and not AMC, the movie theater company. And because it popped above the moving average, I was comfortable shorting AMC here, and they wouldn't let me short the stock directly, so I had to do it in the form of options. And we are now up 80% on that short. I could close it out or let it expire next week for 100%. Another short play, like I said, buying SPXS. We did that yesterday. And if you look at SPXS today, it's up 4% currently. I might just continue to hold this if I think the market is going to tank further. If the stimulus bill that the Democrats are presenting doesn't even make it to a vote, we could see another downturn in the markets. Another option play that I'm doing right now is an iron Condor and Microsoft. This has been open for a while, but basically Microsoft needs to be between, 170 and 185 for me to gain max profit. We are now almost dead smack in the middle as Microsoft has retraced a bit, thank God, because they're, earlier in the week and last week, Microsoft looked like it was going to just skyrocket above 190, which would have put me out of the money on this iron Condor. But if we stay between 170 and 185, then essentially we can collect $218 for every contract that we opened up, right? On 10 contracts, that's $2,180 if Microsoft just stays within this range. That's why options are so lucrative, because there are many ways to play it and you don't really have to be all that right. This is a pretty wide range to be able to collect, $218 per options contract. Also, I could close this out early for 32% gain. We're up 32% on this right now, and it expires May 22nd, so next Friday. Or I could just continue to hold it and it would gain value as long as Microsoft stays within this range. But I especially like the strategy on stocks that are not very volatile. If you look at Microsoft's volatility, it's actually rather low compared to other stocks in the market currently. If you look at its volatility, it's in the 32nd percentile right now. So not very volatile, very ripe for an iron Condor. Looking at the Bitcoin chart, where is it? All right, looking at the Bitcoin chart, Bitcoin has managed to, it looks like it's decoupling from the stock market the last few days. There was a pretty heavy correlation leading up to the halving, but a couple of things have happened. Now that we've had the halving, that's out of the way, and we have also filled this major CME gap right here that was really between 99.50 and around 8,900. So almost $1,000 gap, and we managed to fill it over the last couple of days. Well, it looks like Bitcoin is now decoupling from the stock market because the stock market is tanking at the moment, as we pointed out, but Bitcoin continues to rally. Obviously, it's making up its gains that it lost on May 9th when it crashed all the way down. And at that point, if you were following our portfolio, you would see that we were mostly in cash, waiting to see what the event of the halving would produce. And lo and behold, the market's tanked, whether this was a long squeeze or miners dumping Bitcoin onto the market or people panic selling, whatever the case, we expected a big drop here. If you take a look at my portfolio actually from that time, and this is an outdated portfolio, so I don't mind showing it to you, but if you take a look at my portfolio from before the halving, you'll see that it was mostly cash. If you see here, May 5th, this was before the halving, most of it was cash. I actually did not hold any Bitcoin at that point because we had already sold it the Bitcoin that we bought in the 5K levels, we already sold it. And as you can see here, I got a few comments on the portfolio saying, why you only hold few BTCs, is the price going to go down? I didn't see any Bitcoin holding, only altcoins. But this was the reason, because there were so many factors that were leading up to a potential crash here, besides obviously the fact that we were oversold on the RSI, besides the fact that there was bearish divergence. And then once the price crashed, you could see here that it was finding support on the 100 moving average, and we hit just the lower range of the RSI. Once the price crashed, then I was comfortable buying back at the 100 moving average, even a little bit below that. I think our average price was 8,300 that we got in on Bitcoin. Loaded up at that level and just really waited until Bitcoin made its way back up to the 10K. Now, I haven't sold Bitcoin yet, as it looks to, like I said, it looks to want to decouple from the market. But 10.4K is really a very violent rejection zone. If you look here, I brought this up before, but 10.4K, I mean, you go back months. This goes all the way back to, third quarter of 2019. You'll see that 10.4K, not only do we get rejected, but we get rejected heavier and heavier each time. It's not just a simple rejection. As you could see here, it forms lower lows every time it gets rejected. And this is something that's scary. Now, obviously, if the halving is over and we are truly decoupled from the markets, then there's a chance that the next time this gets retested, we break through. But this is not a good trend right here. The fact that 10.4 is not only a rejection level, but a very violent rejection level. So I'll definitely be looking to set stop limits, trailing stop limits, as we hit the 10.4K level. For now, we're just monitoring BTC. I mean, like I said, if it decouples from the markets, then that will be a paradigm shift, or at least a change in the narrative, in the current narrative for BTC, and then our analysis will have to change. Because there was a time when, we were using the futures and the stock market as also an indicator to try and predict Bitcoin's short-term movements. But if that's out of the window now, we have to do away with that indicator. With new information comes new analysis, right? And new opinions. So for now, just monitoring BTC, good chance that we retest 10.4K, and good chance that we'll get rejected from that level. If we cross above it and close above it convincingly on a few days candles, then we'll start looking to tackle that 14K that we hit in middle of last year. Anyway, that is it for this video. Go ahead and subscribe to the channel if you haven't already. Leave a thumbs up. If you got anything out of this video, leave a comment. Let me know what moves you're making with Bitcoin, with the markets, with options. Do you have any questions about options? Leave it in the comment section below. Sign up if you want access to the trade alerts. I do crypto, stocks, options. We also have a fairly large trading community where we go over ideas about all of these asset classes. We have traders charting all day, talking about their positions, their entries, their exits, etc. I know I learn a lot from running the community, and everyone in the community learns a lot from being in it. So sign up if you want access to that. If you need help with options trading and would like one-on-one training with me, I take a handful of people and we do these one-on-one over video conference or audio conference. But for May, I'm maxed out, but June is coming up. So June 1st, check with me if I have any spots if you want to sign up for that. Stay safe out there, traders. Peace.